Hey everyone, let's jump right into this explainer. Today, we're unpacking a really fascinating, honestly kind of extreme disconnect between market hype and fundamental reality. We're looking at Ultra Clean Holdings, ticker symbol UCTT. If you follow the market, you've probably seen how sometimes a stock's price just takes off, totally detaching from the actual business underneath. Well, we've got a textbook example of exactly that today. We're looking at a stock acting like an absolute rocket ship while its financial engine is basically stalled out. It's a complete valuation paradox, and the data we're about to look at is super revealing. Here's our roadmap for making sense of UCTT's numbers. We'll start with the price explosion, then look at the stagnant growth reality, unpack those valuation multiples, check out the profitability and financial health, and finally look at the fair value disconnect. All right, part one, the UCTT price explosion. Because, look, before we can really grasp the disconnect here, we've got to appreciate just how massive this stock's rally actually is. I mean, just look at this number. If you had bought UCUTT right at the start of the year, you'd be sitting on a staggering 206.55% year-to-date return. In a market where, let's be real, a 10 or 15% annual return is a great year, tripling your money in just months is the exact kind of momentum that turns heads and creates insane hype. And it's not just a short-term, flashy spike either. If we zoom out, the trailing 12-month return is over 262%. But look further down the timeline. The 10-year return sits at a massive 1,437%. Clearly, the market has loved this stock for a long time, just consistently rewarding it with higher and higher valuations. But with the stock recently hitting a 52-week high of $88.50 and sitting on a market cap of nearly $3.5 billion, we really have to stop and ask ourselves, does the actual underlying business justify this price tag? Like, is the company fundamentally growing as fast as the stock, or is this just a massive balloon waiting for a pin? That brings us to part two, stagnant growth reality. Let's pivot away from all that wild market enthusiasm and look at the company's actual operational growth. Because, spoiler alert, this is where the story shifts dramatically. Here's the sobering reality. While the stock price skyrocketed by 220% over the last year, the company's net income growth was flat, literally 0%. Just think about that for a second. Investors are paying more than triple what they paid a year ago for a business that hasn't grown its bottom line by a single penny. And the picture gets even more complicated. It's not just that net income is flat. Revenue is actually shrinking. Over the trailing 12 months, top-line revenue is down 3.24%. Even looking over a 3-year horizon, revenue is shrinking at an annualized rate of 2.67%. Meanwhile, earnings per share and free cash flow, zero growth across the board. So the company is getting smaller in terms of sales and completely stagnant when it comes to cash generation. Moving on to part three, unpacking valuation multiples. What's really fascinating here is seeing exactly how the market decides to price a company that has shrinking sales and zero earnings growth. As you can see, UCTT is trading at massive premiums compared to its own historical averages. You want to see if a stock is historically expensive? Look at its price-to-book ratio. It's currently at 5.54, which is soaring almost 107% higher than its 5-year norm. The enterprise value to EBITDA ratio is sitting at a hefty 31.75. That's 114% higher than its historical baseline. Basically, across the board, whether you're looking at sales or book value, investors right now are paying roughly double the historical premium for this business. But you know what the most glaring red flag in its valuation profile is? It isn't a high multiple. It's a negative one. UCTCT currently has a price-to-earnings ratio of negative 18.10. That simply means the company doesn't actually have earnings over the last 12 months. It is actively losing money. Despite having a $3.48 billion market cap, there are literally no positive earnings to base a traditional valuation on. Let's dig into part four, profitability and financial health. We need to see exactly how much cash is bleeding out of these operations. Because at the end of the day, a business is really only worth the cash it can put in the bank. Before we throw the exact numbers at you, let's just keep this vital concept in mind: free cash flow yield. This ratio is absolutely essential. It shows us how much actual, usable cash a company generates relative to its massive valuation. It cuts through all the accounting noise and tells us what's actually left over for the owners. Well, the margins here paint a pretty grim picture. They start out with a very thin gross margin of 16.07%. That means it costs them nearly 84 cents just to make $1 of product. But then, by the time all the other operational expenses, taxes, and interest are paid, the net profit margin plummets to a concerning negative 6.34%. For every dollar coming through the door, they are losing over 6 cents. In absolute dollars, those negative margins are highly destructive. Over the last 12 months, UCTT lost $194.1 million in net income. They burned through $43.4 million in free cash flow. This gives them a negative free cash flow yield of 1.25% and a highly destructive return on assets of negative 10.78%. So they aren't just failing to grow, they are actively burning through the value of their own assets. Which brings us to part 5, the fair value disconnect. Let's bring all these fundamentals together to calculate what this company is actually worth, based purely on the math. Now remember, a core principle of smart, risk-averse investing is the concept of a margin of safety. This is your buffer. It protects you if the market suddenly wakes up and decides to price a stock purely on its fundamentals, rather than hype. The golden rule is you always want to buy an asset for less than its intrinsic value. So based on the discounted cash flow metrics provided in these source data, when you project out their actual cash generation capabilities, the mathematical fair value price for UCTT isn't anywhere near the high heavens. It is just $5.84 per share. And when we compare that recent $77.65 stock price to its $5.84 intrinsic value, the reality of the situation really hits home. It reveals an absolutely terrifying margin of safety of negative 1,228.78%. There is zero buffer here. The stock is trading at an astronomical premium compared to the actual cash the business is capable of producing. Which leaves us with this final vital thought to take away from this explainer. When a stock's momentum is disconnected from its underlying business reality by over 1,000%, and the company is actively burning cash while revenues shrink, who is left holding the bag when gravity finally sets in? It's a truly fascinating case study in market psychology versus mathematical reality. Thank you so much for joining me to explore the numbers behind the narrative.